Hi, welcome to this episode of the First Trust ROI podcast. I'm Ryan Isakainen, ETF strategist at First Trust. Bob Carey, chief market strategist at First Trust, will be joining me on today's episode. Bob's going to provide his outlook for what to expect in 2024. We're going to discuss different sectors that may provide opportunities. We're going to talk a little bit about what makes companies more profitable, why companies in the U.S. in particular have managed to outperform some of their international counterparts. And we're also going to think about some of the reasons that people might consider in the future allocating to international in some specific areas. Really looking forward to this conversation. Hope you enjoy it as well. Thanks for joining us on the First Trust ROI podcast. So, Bob, thank you for being the second-time guest in the First Trust ROI podcast. It's a great honor to have you on again for, this should be recording in 2023, but this will be the first episode in 2024. Thank you for agreeing to do this once again.
It's an honor to be the first repeat guest.
Yeah, I mean, it's fantastic.
I love it. I appreciate that.
You're a car guy, right?
Love cars.
I have an order in for the Cybertruck. Is this a good idea or a bad idea?
Absolutely a great idea.
And do I go with the Cyber Beast or one of the lesser models? I think it's 1.99 seconds, 0 to 60.
I think my theory is that if you can spend a lot, spend a lot.
Okay.
You can't take it with you, and you are gonna. I mean, that thing is unbelievable. The technology is just incredible.
Yeah.
In that vehicle, no doubt about it.
I'm looking forward to seeing it. I think I may have to put my hands on it before I place my order, but then I won't get an order for a couple of years. So I'm trying to decide back and forth. I'm not sure where I'll.
Now, what kind of range are you going to get living in central New York?
That is the open question.
That would be my only question.
When the weather is below zero for a month straight, what happens to the range?
Driving the thing 10 miles and then all of a sudden you're like, I need a charge.
That's a good point. All this factors into the mental math as I'm figuring out what to do.
Well, I got to ride in something called this Lucid Sapphire this year.
Oh, yeah.
And it is state-of-the-art sedan, electric vehicle, the most ridiculously fast vehicle I've ever been in. This thing is just unbelievable technology.
Okay.
The best part about it were the diesel generators they had to keep the batteries charged up at the racetrack. It's like, you realize, some of the stuff has a ways to go yet.
Diesel generators.
Even with all the technology they had, that vehicle, it was a hot day.
Yeah.
And the batteries were drained in no time at all.
That's amazing.
So,
I'm sure you were going pretty fast.
Yeah, I was a passenger, and that car was capable of going as fast as the track would allow. Yeah,
the technology's pretty remarkable. Okay, so getting to the more, I don't want to say mundane issues of the financial markets, but when compared to going 0 to 60 in 2 seconds, sometimes it feels like that, I guess, when you're...
No question.
So again, we're filming this right at the end of 2023, heading into 2024. It'll air in 2024. I guess my first sort of broad question is, what do you expect to happen, especially in the equity markets over the next 12 months?
Yeah, I think we're in the process of starting to broaden out finally. I mean, we did have a broader market last year in 2022. That was the one thing about the year last year. Yes, it was a tough year.
In 22.
But we actually saw mid caps do better, small caps did well, value did well. A lot of the areas where investors have been maybe underallocated over the last 4, 5, 6 years did reasonably well, and that spilled over into January and February. Mm-hmm. And then March happens. We had banks failing, mm-hmm. and at the same time, it seemed like ChatGPT became a thing. All of a sudden, the AI revolution became much more tangible for a lot of people, and that set us in motion for everything that we saw from that point on. And then we had a correction a few weeks ago. The 10-year got to 5%. We had a big sell-off, and I would submit the market has done. We've had a pretty good rebound. November was terrific.
Yeah.
And it wasn't just the big cap, the Magnificent Seven, or however you want to call it. It wasn't just those stocks participating. So I do think that we're going to see a broader market. I'm not necessarily saying the market's going to do great, but I think that the days of the market being incredibly narrow, I think, are going to go by the wayside. I think we're going to see better participation.
Is your expectation that those companies way at the top, the Magnificent Seven or whatever you want to call them, are going to perform right in line with the broader, say, maybe the equal weight S&P 500 or the mid cap, or do you think that, I look at valuations, they're so bifurcated in terms of those really expensive companies. So do you have an expectation about kind of relative performance?
First of all, I need to look up what bifurcated means. No, I know what you mean. There's no doubt. There's two tiers. You got the very expensive companies, and it's not unusual. I mean, we've had these in the past. We had this two-tiered market back in the late '60s, early '70s. The Nifty 50 stocks. We had a handful of energy companies in the early '80s were 30% of the S&P 500. The big oil companies, and then of course we had the dot-com stocks driving the market back in the late '90s. And I think the one lesson we can draw from those markets is it's not a permanent situation where the market is driven by just a handful of companies. That doesn't last for 10 years. It's usually a very short-term phenomenon, a couple of years, 2 or 3 years. Some of the companies that are highly valued in the end prove to be good investments, but a lot of them don't. And it really is very much a random thing, looking back and looking at the companies that dominated the market then and where they're at today. So you think back to the late '90s, we had companies like Sun Microsystems and Dell and whatnot that were just hugely valued, a lot of expectations, and they're still around, but they haven't done all that well relative to other companies in the same industries, other companies in tech, and that I think that's probably what's going to happen. Is like some of these companies will do well and continue to do well, and some of them will just fade. They will attract competition. Yeah. They will have obsolescence. Something will happen that will cause them to fade. No company stays at a very, very high level of return forever. You become a target.
So you used a word random, and I'm just wondering, is there a way to really to sort out between which companies are going to have be the companies that have staying power? What do you look for? Yeah. And is there a way to tell who eventually is going to be the winner, who's going to be the loser?
Yeah, I think it all goes back to a metric that I've talked to you about before. Companies. Make investments. We think of ourselves as investors when we buy and sell stocks, but really, what we are is we're sorting out how well or not the companies that we might buy, how they're doing at making investments, and are they making the right investments in terms of R&D, new markets, things like that, and that relationship between balance sheets, basically investments, and returns on investments are crucial. And once a company's returns tend to go down, they start to grow at a much slower rate. And we've seen this time and time again. And that's why paying attention to returns on capital, of course, how fast are they expanding those assets is part of the equation as well. But really it's the fade. And if a company's a 25% return business, let's say, and then all of a sudden we look, a couple of years later, boy, they're no longer 25% return business. Now they're a 14% return business. So that decline, usually once it starts, it pretty much sets things in motion, and the companies eventually become typically average or sometimes worse.
So you can't command the same earnings multiple if you're a 14% return business as you could when you were a 25% business.
So not only does the business, what's funny is that a lot of times these companies continue to grow, and their earnings keep going up, but the stocks are just, they're pricing in expectations. And that's always the key, is figuring out, okay, what is baked into those share prices, and then whether or not it actually happens, only time will tell. And if something happens that causes the market to reassess what's happening at the business level, then you get revaluation too.
It's almost like a normal life cycle of a company.
Totally.
And then you have exceptions.
Companies have life cycles.
Exceptions like, I think of Microsoft and what their business used to be 20 years ago compared to what their business is today. They're the exception, aren't they?
They absolutely are. They have beaten the fade, as we say. Yeah. They have absolutely. And then a lot of times companies once they have, gone into the abyss, a lot of times they never come back. Apple came back.
Yeah.
I mean, they commanded a. They
That's
had a
true.
great
They're
business.
another great example.
They're one of the few companies that I can think of that was dominant in a way, and then they faded, and they needed help. Actually, they needed capital to be actually Microsoft, I believe, played a significant role in helping them, come out of their doldrums. And then here they are, a $3 trillion company. So, these things happen, but it's rare, and it is pretty amazing how, most companies, once they hit a wall, that's it. They never get back to what they once were.
It seems like that is the obvious examples are what we've been talking about, technology. But there's examples of that in other industries, other sectors as well, aren't there?
Absolutely. One of the best examples that I can give you is Kmart.
Okay.
One of my first jobs, if you will, one of my first tasks was to analyze Kmart back in the mid-1980s. And they were still, at the time, the largest discount retailer, but Walmart was starting to come along. And if you looked at the two stocks, Kmart was at single-digit PEs, I believe, and Walmart was at a huge premium as far as their PE and growing much faster. And so here they are. They're selling pretty much the same things. Walmart would put a store right next to a Kmart, and you could go from store to store selling the same merchandise. Well, how is it this company was so successful and growing, and this company was not growing? Mm-hmm. And the difference was really more the application of technology. Walmart did a much better job of getting inventory in the stores and sold. They took that cycle of selling everything in the store, and they cut it massively. I think it took 6 months roughly for Kmart to sell all the merchandise in their store and replenish it, the turnover. And I think Walmart had a turnover of like 6 to 8 weeks by comparison. And you could really see that the management team had spent a lot more money on technology and getting, having a much better hand. Really, they were a logistics company masquerading as a retailer. So technology, just implementing technology, even as long ago as the 80s, was a crucial difference in how these companies performed. It was, so it's not just the tech companies that drive fade and have fade themselves and whatnot, but they also impact companies and how they succeed. So,
I'm thinking through what is likely to happen 2024, 2025. One of the forecasts that a number of economics teams, including ours at First Trust, has suggested is that there's likely to be a slowdown, a recession, probable by maybe the end of 2024, although it seems to be a moving target. And I guess
one day we will have a recession. Yes.
That's true. And it's really difficult to forecast. But one of the things that's important, I think, for investors is, what does that mean for your investments? And when it comes to technology, there's certain types of investments that companies can make to become more efficient that are actually, maybe more likely to do when they see a slowdown coming. Is that, is that why we've seen some of the technology companies do better this year, I guess is where I'm.
Well, I think a lot of it just goes back to productivity, right? Companies are always trying to figure out how to do more with less. We are in a very tight labor market, and we have been now for several years, and so substituting investing in technology as a way to boost productivity as opposed to just simply hiring more people has been a huge change in the way companies operate. So I think that's one reason why we've perhaps not had a recession, is that investment process has continued. We also have massive fiscal stimulus, which has probably helped keep the economy from slipping into recession. But now that interest rates are, tighter and higher than they were, it's going to be harder potentially to stimulate through fiscal means going forward. So I think we will have a recession. I think a lot of it is how much does the market look beyond the recession? We know that a valley at some point is going to happen. We're going to see a slowdown in activity. Earnings will probably fall. And so it's really a question of how far into the future does the market begin to look. Do they view this recession as temporary? Or do they start to get very myopic and think, well, we're never going to recover from this? And that really gets back to whether or not we have a softer landing or a hard landing. Hard landings tend to make us much more short-term in our thinking, and the markets reflect that.
Yeah, and that maybe for longer term investors, when you see those sharp sell-offs, that's really often a great opportunity to be buying, right?
Right, because you're thinking longer term, and the market is worried about whether or not things are going to be still around in a couple of weeks, or the next day. I mean, that's what happens. Every once in a while, we have these massive declines, and I think a lot of it is just the market thinking that this bad thing that just happened, whatever it may be, is going to be more of a permanent situation, and sometimes it is for a while, but a lot of times it isn't. That's when we end up recovering. So I think a lot of it just gets back to how long you have, and just how long a time horizon does somebody have before they actually need or will want to use the assets that are being invested.
Right. Okay. So as you think about different pockets of opportunity for, again, not just 2024, but that's the year that we're heading into.
Sure.
So that's what everyone's focused on. But from a sector standpoint, one of the areas that hasn't done as well this year that I would have expected it to do better is the healthcare industry.
Right.
In particular, I look at some of the biotech companies, but healthcare in general. Do you have any thoughts on maybe what has gone wrong this year, if that's the right way to look at it? But more importantly, what's your outlook for the next few years as we think about healthcare?
Well, I think a couple things. First of all, pretty much every sector of the market that's defensive is underperformed this year. Utilities, consumer staples have not done well. I think the fact that we came into the year, we'd seen the Fed raise interest rates last year. The expectation a year ago, we were having this conversation a year ago, that we would have a recession. I think a lot of people decided to put their chips in and buy the more defensive sectors. Mm-hmm. And then here we are almost a year later, and we haven't had a recession yet. So the recession not happening has probably sent some investors looking for things that are not defensive. We also have higher interest rates this year. The higher rates do impact valuations across the board for everything, but there's no doubt about it that higher rates, a lot of these companies pay pretty sizable dividends in some areas. That's also part of it. But I think the healthcare sector, you do have a combination of different companies. You have these big mature pharmaceutical companies.
Right.
They are in some cases doing well if they've got weight loss drugs, and if they have anything that isn't
remarkably well this year.
Yeah, and if they don't have that, it's like their stocks have not done well.
Right.
So it's really, once again, kind of a two-tiered market for those companies. But I think the biotech innovation, it's still happening. The R&D spending as a percentage of revenues, that number is still very, very high. I think that quite possibly politics might be the main reason why biotechs haven't done this as well this year. I think that might be part of it.
Yeah.
We always worry as investors in that particular space about price controls eventually coming into play.
Yep.
And here these companies have spent all this money bringing these products to market, and all of a sudden it's not market forces driving pricing, it's the government driving pricing, and that definitely spooks investors.
Yeah. You mentioned interest rates. The other part of interest rates, apart from competing with dividends, it seems to me anyway, some of those smaller biotech companies that aren't profitable, that are, they're relying on capital markets to actually fund their operations. It seems to me that is another headwind that has been, in their face this year. Right.
It's risk capital. How much capital is willing to go in to take the risk of investing in these companies that need capital, that need time? I think companies that have proven getting to milestones, I think will probably have no problem getting capital. I think there's plenty of risk capital to do that. It's just, the market at this point realizes that a lot of these companies are eventually acquired by big pharma companies. And when those stocks get hit, that is effectively their currency, in many cases, that they use to buy some of these smaller companies. So, it's kind of a snowball effect where if the big cap pharmas are under pressure, then that's going to spill into anything that they might invest in or acquire as well.
The other thing that you said that kind of struck me, talking about price controls, for example, I think some of the provisions of we've talked about this before, the Inflation Reduction Act, that we're applying price controls starting 2026, I think, and then it kind of ratchets up from there. But one of the things that seems to do if I understand it properly, is it shortens the life of certain drugs, their pricing power over those drugs.
That's right.
And it's similar, in my mind, to when you reach the end of a patent. The exclusivity in the market pricing capacity of those companies ends, and so what do? Well, they go shopping. They try to find attractive intellectual property that they can acquire, especially if a company's gotten cheaper.
That's right.
And then you start to see the M&A cycle.
We have seen some deals this year in that space. More so, we didn't see very much last year. But this year we're starting to see deals getting done. Companies, we've seen some takeouts, some buyouts. So I think it's kind of percolating that companies are realizing, well, we've got to go. We need to figure out what we're going to be, 5 to 10 years down the road. And so making sure that you have the pipeline filled up with new products is what it's all about.
Yeah. Do you have a take on interest rates? And let me ask it in two ways, because I think we can kind of get them confused sometimes. One is Fed policy, but two is more market oriented at the 10-year and beyond. So what do you think is going to play out going forward here?
Yeah, I've been concerned about interest rates going higher for the last couple of years, and we did see the 10-year get to 5%, which I thought was probably at the high end of a range. I think the low end of the range is probably wherever inflation is, and inflation right now is running maybe 3.5%. Wage inflation, I think, was 4% in the last report. So I think the 10-year should be at least at those rates, and we kind of touched those rates. Now we're back up to 4.25%. I think that unless we have a really, really sharp decline in the economy and the Fed is massively cutting rates, I think the 10-year stays at these levels. And I think that the idea that somehow it's going to go back down to 2% or 3%, I'm not really in that camp yet at this point. I think it's going to depend on the economic data.
Yeah, no, that makes sense. The other thing that's been interesting is in the real estate industry that's obviously very sensitive to rates, and just some of the lockup that we've seen in terms of transactions. There just hasn't been as much, and I wonder, is that going to influence?
You mean commercial real estate or more residential real estate?
I'm thinking about residential real estate. I mean, mortgages have been so high. There's just in certain markets not a lot of turnover.
That's right.
Because why would you want to refinance your mortgage? You want to hold on to it as long as you can.
Absolutely true.
And so there's not as much commercial real estate. It seems like there's a whole set of other problems that are probably also somewhat related to rates and somewhat related to people not going back to cities.
Right.
But do you have any thoughts on that? No,
I think you covered it. It really depends on location. Obviously, it depends on what kind of asset you're talking about. I think the one aspect that I keep thinking about with where mortgages are at today is we've got a lot of people that locked in mortgages when rates were lower. It became so easy to refinance.
Yeah.
And now that rates are higher, we've got incomes going up, wages going up, and that obligation has been locked in at a lower interest rate. And I think that's probably good for the consumer. It might be one of the reasons why consumption has remained fairly strong this year.
Sure.
If you have any kind of savings at all, you're earning income now on your savings. You weren't earning anything two and a half years ago. So now we've got, basically, if you've paid off your mortgage, or if you have a mortgage that's at a low rate, and your income is going up, and you've got savings on top of that, your cash flow position is terrific. You've got money to spend from a discretionary standpoint that you might not have had a couple of years ago.
Yeah, there's an incentive to save now that wasn't there for that span from 2008 till just a few years ago.
You think about it, we had the Fed kept interest rates below the inflation rate for more than a decade. That's not good.
Yeah,
that's not a good thing. And on the other side of that, we're at the point now where our savings are actually earning us more than inflation. I'm hoping that actually remains the case. I know a lot of people would like, we need to cut rates, and there's going to be enormous pressure on the Fed to cut rates. And I think that's already starting to build, and we've got a Fed chair who's going to be in office for 3 more years before he has to step down. So, under Greenspan, those 19 years, for the most part, he kept interest rates above the inflation rate for 19 years. And when he stepped down, he finally retired, he did such a good job that Washington got together and said we can never let that happen again. And now the Fed has 2 terms, and they're limited.
Yeah.
You know? So I think the one aspect of those low interest rates for all that period of time was that it did encourage the government to spend money. And we had a lot of fiscal stimulus here the last 5 years, especially during COVID, coming out of COVID. They had the excuse that they needed to raise spending. And I know our colleague, Mr. Westbury, is absolutely, he's terrified of that. He's very, very concerned. And I think it's a legitimate concern. We really don't, we don't need the government to be this big. So it's going to be a very, very big issue here going forward.
It seems like one of the aspects of those fiscal spending programs that is intriguing to me is that they're not just a 1 year or a 2 year thing. They're packages that were maybe 5 years.
That's right.
That were passed, in 21, so from 22 to 26 or something like that.
Right.
And so it seems like they're going to have an influence for the next few years.
Yeah.
Maybe not from a growth standpoint, but putting all that capital into the system, you can't just, cut it off because there are already bills that have been passed and laws that are in place.
It's very hard for the government to stop spending money. I mean, the only thing that will change the trajectory of fiscal spending, I would have to imagine, would be interest payments going up. And if all of a sudden we've got a larger share of the budget, just simply interest payments on the debt, those are dollars they're apolitical, and fiscal spending a lot of it's politically driven. Yeah. And those interest payments aren't political, so there is an incentive eventually for whoever happens to be in power at the time to get the spending under control so that interest rates come down. Yeah. That's basically the story of the 80s and 90s. So I know Bob Stein has been talking about, well, maybe this is the one byproduct of these deficits and these higher interest rates, is that it does bend the curve a little bit as far as fiscal spending going forward.
Yeah, well, that's one can hope that is what plays out. And
I'll let you talk to Bob about that. The other Bob.
Yeah, we actually will have a call or a podcast with Bob next. It'll air in February. So that's a commercial for the other Bob.
He's the guy to talk to as far as politics and all that stuff.
What do international markets look like from your perspective with respect to, especially the equity markets? We look at valuations; they seem pretty attractive, but obviously valuations reflect what people think about those assets. What do you think about them?
Well, there's a big gap between wealth creation trends, earnings growth trends in U.S. companies versus the rest of the world in general. There are some exceptions, but I do think that the dollar is right about where it was at the beginning of the year. If, in fact, the Fed is on pause and we actually start to see the Fed cutting interest rates, the dollar might cool off a little bit, which would be good for those markets. The dollar still has some influence on things, but just taking a step back, there really is there's just no comparison between how U.S. companies are doing at creating shareholder value versus their counterparts overseas, especially companies in Europe, in Japan. It's going to take a shift in policies probably for that to happen. We were talking about Microsoft and some of these companies. We look at those kind of magnificent 7 stocks and you start looking, well, are there other companies overseas that have the same sort of characteristics? It's hard to find them. You really don't see them. Right. And that's one reason probably why the market here has done so well relative to markets overseas, is that we have something here that you just simply can't get in Europe or Mexico or Japan or even China. Yeah.
Yeah, I sometimes wonder some of those, what trends of sort of shifting supply chains, what that's going to do for opportunities. We've just seen such a beginning of build-up down in Mexico and maybe some South American, Latin American countries, shifting some manufacturing out of China in some of those places.
The world is no longer beating a path to China like it once did. Yeah. And I think the beneficiaries are, for the most part, here in the Americas. I really do. I think a lot of capital's come back this way.
The other thing that is sort of intriguing, and I'd like your take on, is in Europe there's a concerted effort to shift to more renewable sources of power, and obviously there's some push in the U.S. as well. But it seems like whatever you think politically on that issue, or even from an investment standpoint, that's going to require expenditures. You're going to have to spend money on that, yeah. And that seems like that would be for those economies a cost that maybe you're not going to get paid back. Maybe get paid back over the long term. But it seems like that would be a push for maybe inflation, but certainly lower margins. Am I thinking about that right?
No, I think you are. I think ultimately a lot of these expenses are heavily subsidized by governments. There is the massive subsidy aspect to these things that, and the fact that it has to be subsidized, you end up with misallocation of resources. And I think that is definitely a problem. And a lot of companies in Europe, successful companies they're very much global enterprises. These big companies, in many cases, have operations all over the world, and they're looking at their home markets, going, I don't know that I want to invest in my backyard, or I can make investments in the U.S. or I can make investments elsewhere.
Yeah,
and maybe be closer to my customers that way too.
And that's not to say there's not pockets of opportunity. We're not like overstating that, because I think there probably are.
I just think you need to be more selective
Sure.
when you go into overseas markets. I think it's fun. We've been having this conversation now for almost 15 years, and the old model. Well, I need to be 30% invested overseas. I think a lot of that assumption is backwards looking. First of all,
yeah.
And I think that in previous times there really wasn't a huge difference in performance between U.S. companies and maybe companies in Europe or Japan. If you threw a blinder on me and just gave me the numbers, I couldn't really tell you much difference between a company in Germany or a company in the U.K. or the company in the U.S. or Canada. But increasingly, boy, the U.S. companies are just simply better at what they do. And the end result is higher returns on capital, more growth, and a lot of it's just technology. We're more tech intensive, and it's made us more competitive.
Last question I have for you, international markets. One of the areas of the world where we've seen pretty decent growth in 2023 has been India.
Yeah.
And obviously there's some different things between, say, India versus China or some other markets. They've got a different system. And I guess I'm curious on what your thoughts are, if you have any on India. Do you have any perspective that you could share?
Really nothing earth-shattering, but I think if you are concerned about China, from a political perspective, maybe you're not trusting that they are truly moving in the direction that you want them to move from a long-term perspective. I think India is a good alternative.
Yeah.
They seem to be becoming much more market-driven. They still have a lot of issues, a lot of corruption. Their fiscal situation is, they spend a lot of money too, but they have. There are companies in that market that are in tech, they're in healthcare, they're in high growth industries, and I think they've been a beneficiary. I think of a little bit of the reluctance to go into China. I think some of that capital has gone into their economy.
Yeah.
So I think it's done well this year, and I think it's a market that if I had to go into EM, I would definitely put that on my short list of somewhere where I would want to have some allocation.
Okay, makes sense. Okay, so one of the questions that I've started asking my guests on the ROI podcast that I've gotten some really good recommendations from, so I'll ask you, is are there any specific books that either are on the Bob Carey reading list or maybe that you've read recently that you would recommend?
Yeah, I have a book that I would recommend. I know a lot of people listening to this podcast are financial advisors and work with clients. A friend of mine by the name of Stan Slovin wrote a book called Better Listening, and I am about a third of the way through the book, and it's a really easy read. It's filled with a lot of good advice and good anecdotes about just learning to become better at asking the right questions and getting more comfortable asking questions. It's applicable to not just financial advisors, but I think people in general. And it's a terrific book. And I would recommend it. It's just better listening. Better listening.
That seems like a skill we could all probably benefit from.
Amen. No question about it.
Yeah.
The other book that I recommend, that I would recommend. This is an old book. It's been around for a long time, but it was written by a guy by the name of Julian Simon. And when I started my career in the mid-1980s, I used to watch the Nightly Business Report on PBS. It was, we had, we didn't have CNBC at the time. We didn't have the Fox Business Channel. There might have been like a local cable show might have been dedicated to financial markets, but usually the big business show for us in the industry was to watch the nightly business report. Well, they would have commentators on at the end of every episode. So it'd be 30 minutes of market commentary, and they would have somebody come on and they would give like a 2 or 3 minute just commentary about something. And quite a few of the people were economists and legends in the industry, and legends of not just Wall Street, but in academia and whatnot. And this guy, Julian Simon, I remember watching one of his little short vignettes that he did for the show, and I'm like, wow, I really liked what that guy had to say. And you start delving into his history and whatnot. And he was a frequent guest on Louis Rukeyser's show, which is what we watched on the weekends, back in those days. And I really love the guy. He was just a terrific individual. But he wrote a book called It's Getting Better All the Time. And it's been around, he wrote this years ago. And I think it's one of those books that you need to read like every couple of years. Or,
sure.
Let's once a decade just dust it off and read it. And it's one of the things that I did this year. I'm like, I hadn't read that book in a long time.
Yeah.
And I read it again here a couple months ago, and I'm like, I don't know. I feel it's just a reminder of just how far we have come as people in the last 25, 30, 40 years. Now he wrote this book, years ago, decades ago. But I think it's one of those evergreen books that I think
some of those old books are. I actually just started reading again. It's a really short book, but that old Dale Carnegie book, How to Win Friends and Influence People.
Yeah.
I mean, just some of these fantastic books that.
Absolutely.
I mean, they have some examples and things that are decades and decades old. And
another book, Economics in One Lesson. This guy Henry Hazlitt wrote a very, very small book, and it's just basically, if you really want to understand economics, this is all you need to understand, or not all, but it's if you want to kind of get a foundation, same thing. It's like, I read that again a couple of years ago, and I remember reading that when I first started working in this industry, and it's good to go back and revisit some of these things.
Yeah, fantastic. All right, final question for you. Again, looking out, 2024 is upon us.
Yep.
What makes you optimistic?
Well,
and it doesn't have to be in our industry. It doesn't have to be. Well, Bob Carey, what makes you optimistic in your outlook on life or the industry?
Well, I think the one thing that I keep getting back to is that we do continue to come up with new products and new services. I mean, not just here in the U.S., but everywhere. Everywhere that's free, it is remarkable all the things that we have available to us, and all of the. We talk about technology, but even things that we buy. You were talking about the Cybertruck.
Yeah.
You think about it. It's a truck, right? Trucks have been around for 100 years. It is remarkable how we continue to innovate and come up with new things, and I think that to me, that's exciting. That's what makes me want to get up and go to work and have the resources to maybe buy some of these new things as they become available. And I know I'm not alone. It's I like having old things too, mostly guitars. But I think it's remarkable how much innovation is impacting the way we live, all of us.
It's pretty remarkable. You look back at the not too distant past, and it's a lot different than we are today. And who knows what the next 5 or 10 years holds in terms of innovation.
I interviewed with Intel back in 1985. I was finishing up college. I had taken a class in something called condensed matter physics, solid state physics.
Light class.
Yeah, it was
light elective.
It was pretty much, if you managed to get through this class, you had a chance to get a job in the semiconductor industry.
Sure.
That was the goal, right? Well, there was a recession actually in the semiconductor industry going on, in that particular year, because of cutbacks in defense spending. And I mean, you think about
that's
where. So I interviewed, and it turns out they weren't hiring anybody. That was like they were in a hiring freeze. But I remember this interviewer at Intel was all excited because, hey, we're going to be $1 billion company here fairly soon.
Yeah.
They were like, wow, we're going to be $1 billion company. Obviously, the company's a lot bigger than that today.
Sure.
And it's not just Intel. There's a lot of other companies that are significantly larger as well. So it's it's interesting having that perspective now of almost 40 years of looking at this stuff and being around it. It's, I think that's where I draw a lot of my inspiration from.
It's like the title of the book. It's getting better all the time.
Yeah, it might not seem like it. And it's not that we don't have struggles. Everybody goes through struggles, but taking a look at the big picture, and I think that's the big thing is people are getting older and living longer, and you've got to have something that is going to create some shareholder value, some wealth for the eventuality, the potential that you're around, 20, 30, 40 years down the road. It might not look to be a lot of fun in the short term, but I think it's important to have those assets and think longer term. And I think especially with our call for recession, and it's you got to make sure you have enough capital to get you through a downturn, because it is disruptive, but thinking more longer term I think is critically important.
All right, that's a great place to leave things. Bob, thanks for making a second appearance on the ROI podcast. I'm sure we'll try to get you on some 6 months down the road if we can lure you back on.
Just give me a call.
Well, thanks, Bob.
You're having no trouble getting people to join this, so I think it's wonderful.
Yep. Appreciate you, and appreciate all of you who have joined us on the First Trust ROI podcast. We'll see you next time.